A recent study found that an all equity strategy actually outperforms the traditional advice of diversifying into less risky assets as you age. Joining me now is Ed Rempel, a fee for service financial planner and tax accountant, to discuss whether the strategy is actually accurate or the study is actually accurate, or is it just reaching for headlines. Ed, thanks for joining me again.
Glad to be here, Barry. It's always fun.
So I think the first question for most people, like, is this study actually high quality or is someone actually making up these numbers?
Yeah, it's a very high quality study. It's based on a paper titled "Beyond the Status Quo: A Critical Assessment of Life Cycle Investment Advice." Um, it was published in December 2024, so it's quite recent, and it's three finance professors that put all this together. And the study improves on past studies by looking longer term over the time of a typical retired couple, and by fixing date issues such as survivor bias, and by including long-term data from 39 different developed countries. So it's much more in depth than most previous studies of this type.
Okay, so you've obviously studied this quite a bit. You've talked about it. What does the study actually prove, though?
So, okay, I'm gonna quote a couple sections directly from the study, so you'll see. So one quote is, "The study shows an optimal lifetime allocation of 33% domestic stocks, 67% international stocks, 0% bonds, and 0% cash vastly outperforms age-based stock bond strategies in building wealth, also in supporting retirement consumption, and also preserving capital, and also generating bequests." So that's the direct quote. So in other words, 100% equities with two-thirds in international stocks has been far better than the two conventional wisdoms in providing high growth, higher retirement incomes, and more reliable retirement incomes. So, I mean, the two conventional wisdoms are, one is that you should diversify into stocks and bonds, and the other one is that older people should, invest less in stocks as they age. But this study proved that both of them are, it's better not to do both of those.
So this is actually interesting because obviously when I started to get into personal finance 10 years ago, those were the exact two things I read about first. So it made a lot of sense to me. But even then, over the last 5 years, I do feel I've seen more studies similar to what we're discussing now. I think the thinking has changed. So what is the effective way to diversify now?
Okay, so here I'll also give you a direct quote. It's a bit longer one. It's a little technical, but I just want to make sure you understand what it says. So I'll summarize it. So the quote is: "Investors should prefer international stocks to bonds for diversification. So bonds offer modest average real returns, like 0.95% annually, after inflation, compared with international stocks about 7% a year after inflation. So, which necessitating a strong diversification benefit to make bonds attractive. At short horizons, bonds appear less risky with lower standard deviation of only 9.5 versus 23.2 for the international stocks, and a lower correlation with domestic stocks, zero point 0.2 versus 0.33. But at long horizons, the picture changes. Bonds, standard deviation increases to 2.3 times what it was, the 1 year variance. But international stocks decrease by 0.75 to 0.75 times. So the correlation of bonds with domestic stocks rises to 0.45 at 30 years, whereas international stocks maintain a steady correlation of 0.5. So international stocks also help preserve real buying power with a low correlation with inflation, like basically zero, whereas bonds do not. They're like a negative zero point 0.8 correlation with inflation. Bonds ultimately seem unattractive for long-term investors. They have low returns, high long-term variance, high long-term correlation with domestic stocks, and high exposure to inflationary periods. So, okay, so that's the quote. So, in other words, bonds have a minimal return after inflation. They offer low long-term diversification. It's the diversification over 1 year is pretty good, but over long term, there's actually hardly any diversification. Are much riskier over a long period of time than short periods of times, and they get killed if there's inflation. So if you have 30-year retirement or whatever, you're investing for 30 or 40 years, and there's inflation anywhere in that time period, bonds can get killed. One more short quote from the study. Yeah, it says the optimal allocation avoids fixed income investments and chooses an all equity strategy. This result may seem surprising given the vaunted diversification potential and safety offered by bonds. However, bonds become riskier and more correlated with domestic stocks as the investment horizon grows. So the optimal allocation reflects a superior diversification benefits and growth potential of international stocks. That's the quote.
So, in what two ways should people diversify with international stocks, and how do they, I guess, how are they better than using bonds?
Again, the 100% equity strategy, dominates those two conventional wisdoms with 50% more retirement wealth on average than using balanced strategy, and 39% more than using target date funds, where you're changing allocation as you age. So this additional wealth generates more income for retirees. So it's more money. It's more comfortable retirement. 50% better retirement for a couple saving 10% of their income into the 100% equity portfolio to have the same retirement. So it's 10% for the all equity. You have to save 19% of your income. Like this is through your entire working career. 19% of if you're using the balance strategy, which is nearly twice as much. And with the target date funds, you need to save 16.1%, so 61% more of your pre-retirement earnings. So over your entire career, you have to save way more if you're using bonds and cash. So note the study refers to target date funds as life cycle investing. The study actually has life cycle investing in the title. Okay, so in my blog, I talk about there's a conventional wisdom. Okay, there's a conventional wisdom investing more in bonds as you age, which is what he's referring to. Now, it's completely different than the life cycle investment strategy that's on my blog, which is a strategy, it's ultimate strategy for investment strategy for young people. So life cycle investing as a strategy that I talk about and life cycle investing in this, that they talk about in the study are not the same thing. The other thing is a surprising result is that the all equity strategy also beats conventional wisdom in capital preservation, which was maybe surprising. So 100% equity preserves capital better than a balanced portfolio. Isn't that surprising? So this agrees with my research that bonds are not safer for a 30-year retirement. So Jeremy Siegel's studies also agree. They show that bonds have a higher standard deviation after inflation for 20-year periods or longer. Now, so households allocating 33% to domestic stocks and 67% to international stocks are much less likely to exhaust their savings. So under the common, or this is actually a direct quote again from the study. Okay, so households allocating 33% to domestic stocks and 67% to international stocks are much less likely to exhaust their savings. Under the common 4% rule for retirement spending, a couple using the balance strategy has a 17% probability of running out of wealth. Target date funds, it's 20%. And in comparison, the probability for the optimal all equity strategy is only 7%. So he calls that the ruin probability. We got a chart on that.
I know this is called the all equity strategy, but at the same time, why should people keep everything in stocks when they age?
So here, actually, the direct quote from the study is, there is no economically meaningful gain from holding bonds at any point during your lifetime. The long-term return data suggests that diversifying with international stocks rather than bonds improves investor outcomes for long-term appreciation and for capital preservation. So he actually has examples specifically of 80-year-olds. So the study shows that the ruin possibility is far lower for the 100% equity optimal strategy.
So the next question for many people has got to be is like, is it safe? Going 100% equities sounds crazy to some people.
So, yeah. So okay. So here, there's a direct quote again. It says drawdowns can inflict intense psychological pain, and one worry is that some investors will abandon their investments rather than stay the course. So, contrary to common intuition, however, conventional wisdom with large bond allocations carry the potential for even large drawdowns in real terms, like after inflation. So these strategies also expose investors to greater risk of exhausting their savings. So in other words, bonds are less reliable for a 30-year retirement because they get killed by inflation. So now here's the quote that directly addresses what you said. So the quote is, our results as a whole do not suggest that all equity strategy is safe. They merely suggest that it is safer than common alternatives over the 30 years. So, given the relative safety and strong growth potential of equities, retirement savers and retirees would likely benefit from adopting a set it and forget it strategy that fully invests in domestic and international stocks.
So I guess with this strategy, even though it's all equities, it does recommend 2/3 of your portfolio be international stock. But I remember reading when I first started investing that you should actually have more in your home country, for us being Canada, home bias. So should we actually invest that much in international stocks?
Yeah, so the study looks at 39 developed countries altogether, and having 33% in your home country and 67% out on average works for all the countries. But I'm sure what they didn't address, I'm sure this optimal allocation is different for different countries. So, for example, looking at stock market indexes in the study, so several countries such as Chile have negative returns during the study for the entire period. The returns are negative, while the countries like Czechoslovakia, Finland, South Korea, Norway, and Mexico have returns between 7 and 10% per year after inflation, over the entire period. So you'd expect a country with a stock market that declines over years to have a lower optimal allocation in its domestic stocks than countries with high long-term returns after inflation. So, putting 33% of your in your own country when the stock market declines over decades is probably not an effective strategy. So now I read the blogs so it's different for different countries, I think. I read blogs from American investors wondering why they should not invest 100% in the US, which seems like an interesting question, because the US market has significantly outperformed the rest of the world. And the last several decades, it's outperformed the rest of the world over the last few decades, and U.S. stocks are 70% of the world index anyway. So now growth in the world is mostly in a few countries, including the U.S. So now the study says that diversifying with international stocks is much better than diversifying with bonds or cash. We also only have 150 years of stock market data. So being all in one country is probably a higher risk. Like in the US, it actually looks like, if you just look at the data, it looks like being 100% in the US is the best thing for people that live there, just be 100% domestic. But I think it's probably still better for them to have, international as well. Now, the portfolio manager that we work with here in Canada actually has almost nothing in Canada. So, Canada is only 3% of the world stock market. It's a lower growth country. They invest globally, the portfolio manager, to get broad international diversification. So recently, they've been more heavily focused in the U.S. It's very been large lately, but because that's where all the growth is. But I believe they've been reducing a little bit this year. So now the Canadian stock market has had lower returns than the global and U.S. Markets, and it's not proper diversification. I would say it's not a real like a TSX 60 is not a proper portfolio, since it's just mainly finance and resource stocks. So, and also, current government regulations essentially block new development of resources in Canada, even though we're known as a primarily a resource country. So we're not really a growth country here. So my view is that having a minimal amount in Canada, investing 100% globally, should achieve results similar to what's in the study. So then you're basically, all global. I think that should be similar to what they talk about in the study.
Now, Ed, I'm sure you've read a lot of studies. You're a financial planner. This is probably what you do daily. But are there any studies that you've read that kind of back up, like alternative studies, obviously, that back up this study? And have you featured them on your blog or YouTube channel before?
Yeah, so if you're following my blog or YouTube channel, you'd know I have seen through these conventional wisdoms for many years. So the unconventional wisdom works. Like 100% equities and global. It just kind of works. So on my blog, I've said you would see the charts there's a study by Professor Jeremy Siegel in his book Stocks for the Long Run. He's had, I think, 6 versions of that book. So So that's one study. And my study, I did a study of the long-term returns of U.S. Stock markets, and then I did another stock study of the 4% rule. So that's using it after you retire. And these studies and these charts agree with the new high-quality study. So the stocks for the long run shows much how much stocks outperform bonds and cash, and how much more reliable they are. So they have a 200-year chart, and you see basically this, the long-term trend, 7% after inflation. Basically, stock market's been very close to that the whole time. Yet bonds have, 40-year periods where they lose money after inflation, and then 40-year periods where they gain. So it's actually, you can see it, they're not nearly as reliable, and the growth over time is much, much lower. So the book Stocks for the Long Run also shows how stocks have been more reliable than bonds after 20 years or more. So they show the standard deviation, which is the common measure of risk, and compare stocks with bonds with cash. And of course, stocks have a higher standard deviation. They're riskier for 1 year, 2 year, and 5 year periods. But when you get to 10-year, they're pretty well the same. And surprisingly, for 20 years and longer, stocks actually have a lower standard deviation after inflation than bonds and T-bills. So you can more accurately predict where stocks will be after inflation 20 years from now than bonds or cash. So now I accumulated the history of U.S. stocks for 25-year rolling periods to show how reliable they've been. So basically going all the way back to 1800s, if you take 25-year rolling periods, it's basically always made more than 5% a year. And, the modern stock market started, let's say, around 1930 or so. And since then, the worst 25-year period, calendar year, has been 8% a year. So it's been quite reliable, as a long-term investment. Every year it goes up and down, but you're in for 25 years. It's been quite reliable. I also did an in-depth study of the actual results of the 4% rule over 30-year retirements in history. So it's a very colorful chart, and it's actually it's the actual 30-year histories with 100% in U.S. equities. So it shows it has had the chart that's had a 96% success rate in history, and almost all retirements ending with much more than after 30 years than when you started. So I've got on my blog, I've got the same study with different allocations. Like, what if you had 10, 90-10, 80-20, like, had it all the way down to the 60-40, all the way to 100% bonds. And you see the success rate is much lower as you add bonds. So I actually looked at it again over 150 years. What if you actually, use the 4% rule for a 30-year retirement? So my 4% rule study also shows how adding bonds has resulted in higher, not lower, risk of running out of money compared to the all equity investing during your retirement. So I have a chart that actually shows that there, and it's it shows you about 96 to 97% success rate. So that's historically been the odds of your money lasting at least 30 years if you're 100% equities. And if you see it as you go, if you're 100% bonds, it's only a 47% chance of success over history. So it's and the more if the 4%, if you take more, like 5%, then you see the decline right away. As soon as you take more, the more you take, the more you have in bonds, the more likely you're going to run out of money after 30 years.
I imagine this kind of study got quite the reaction from whether it be investors or advisors themselves. What kind of feedback have you seen?
Yeah, I did a video about this study on my blog, and I got a lot of comments. So let me just cover the main things. It's actually quite interesting what people noted, because it might be what people here are thinking too. So first thing is, most of the readers actually agreed with 100% equities and explained how it worked for them. So we got lots of examples of how in their case, it worked. So now, another comment I got is, does the study support 100% equities right through retirement? And the answer is yes. So the study has a section specifically about 80-year-olds and how generally they are still best off with 100% equities. So note, this requires that they're able to stay invested when their investments go down. So the authors say this strategy is not safe, but it's safer than holding bonds or cash, for longer periods of time. So Some other comments were, if an 80-year-old is 100% in stocks and we get another financial crisis, how could they possibly recover, especially when having to potentially sell stocks at low points every month to pay the bills? So that's a question. So my response there is, we have direct experience with this. So we have clients that achieved their retirement goal and retired. Unfortunately, it was the summer of 2008. So 6 months after retiring, their investments were down 40%. So that's the catastrophe. That's the worst case scenario. So what did we do? So we just kept sending them the cash flow that was in their plan. We monitored their withdrawal rate. In some cases, we had to reduce the income by 100 to 300 a month for a while. But in 2 to 3 years, they had fully recovered. So note, this was the largest market decline since the 1930s, and investors were still fine if they just stuck with their plan. So it's, people are always terrified of that, but usually you just people think, I think that your investments go down by 40%. I have to take 40% less. No, the idea is you still take the same amount out. You just kind of monitor it, maybe reduce it a little bit, and just give your investments several years to recover. And historically, that's always worked. Some other questions, like a few people asked, won't many people panic and sell? And the answer is quite possibly some might. So this study does not say 100% equities is safe or that it's recommended. It doesn't even say it's recommended. It's just that people that do it for the long term will almost definitely have a more comfortable and a more reliable retirement. Their risk of running out of money is lower. My experience is that risk tolerance is a learned skill. Many people can learn to tolerate significant declines. A risk tolerance is the ability to do nothing when your investments are down. That's how I define risk tolerance. So with education about market history and probably working with a trusted advisor and some experience, people can learn to do nothing. And if they can, they're highly likely to retire more comfortably with 100% equities. Some more people said, why stay away from bonds? And the answer is, bonds barely keep up with inflation long term. So they add hardly any growth. They're not reliable long term after inflation. From 1900 to 1982, people are shocked by this, but from 1900 to 1982, it's 82 years. Bonds made zero after inflation. That's 82 years with zero return. From 1940 to 1980, that was a 40-year turn. Bonds lost 50% after inflation, after 40 years of investing. So I'm not talking about, stocks where they go down and come back. I'm talking 40 years later, after inflation, they were down 50%. So bonds have big catastrophes, much worse than stocks over the long term after inflation. And the standard deviation of bonds after inflation is higher than stocks for periods of 20 years or more. Bonds are steady short term, but are not reliable as a long-term investments if there is inflation at any time in that period. So inflation being as high as the yield on bonds happens often. And we had that. That's why we had from 1900 to 82, bonds made zero after inflation. So, some more comments. One was, would this work in some time periods but not others? And this study showed that the returns were higher and risk out of money lower over your lifetime, including right through retirement. So even different time periods. It looks longer term over the time of a typical retired couple. It did not work 100% of the time, but far more often than conventional wisdom using bonds. And so other comments I got is, isn't the risk of running out of money in retirement similar for 100, 80, and 60% equities? And actually, yeah. So my study on that showed, the 4% rule. If you just follow it, it had a between 96 and 97% success rate in history for portfolios with between 70 and 100% equities. So you don't have to be 100% equities to get that most reliable. So for higher withdrawal rates, such as 5%, the highest success has been portfolios of 90 to 100% equities. So it's, if you withdraw more, then you got to be almost entirely equities to get the highest success rate. So this implies that higher equities is likely more reliable over a 30-year retirement in both steady and extreme markets. Of course, the higher the equity allocation, the higher the long-term returns on average, with the same or lower risk of running out of money. So the study just shows that what has worked it just shows what's worked over time for most long-term investors. So you can go from 100% to 70% equities, and you still have a similar risk of running out of money. However, you're probably making quite a bit lower return over time, right? So yeah, bottom line is it has to fit within your risk tolerance. You got to be able to stick with it, but it's just showing you that this, it did actually work. It gave people a more comfortable retirement if they could do it.
Viewers want to see this video that you produced or get in contact with you. What's the best way to do so?
All right, so I have a blog, YouTube, and podcast. The blog's called Unconventional Wisdom. It's actually the #1 blog in Canada for a full-service financial planner, and it's just my name, edrempel.com. It's also unconventionalwisdom.ca because we're in Canada. We offer a free 30-minute consultation if you're interested in potentially talking with us, and it's just edrempel.com/talk. If you subscribe to my blog, podcast, and YouTube, all it means is you get a email once a week with whatever my new video and or our blog is. Podcast is edrempel.com/listen. YouTube is edrempel.com/watch.
Okay, Ed, thank you again for joining me at the Canadian Financial Summit this year.
Great to talk to you again, Barry.